Hey guys, when we invest our money, we are typically investing into companies, and those companies need to make some money in order for us to generate a return on investment as investors. Today I'm going to speak to you about 7 key numbers you need to know as an investor. These numbers are the foundations for you to determine whether you are actually making a good enough investment. Let's say you want to go and invest in a particular company, for example. How can you determine whether that company is worth you investing in? Whether it's cheap enough at this very time for you to invest your money into that particular company? Today I want to share 7 numbers that I'd love for you to understand well enough, not really to understand how they're calculated, but more specifically to understand what those numbers are saying to you so that you can gain confidence in order to invest your money wisely over time. My name's Ken of the Humble Penny and Financial Joy Academy. What we do on this channel is to give you guys the tips, the insights, the practical hacks to help you work towards a dream life of financial independence and money joy. Now, these 7 numbers I'm sharing with you are not the only numbers that you need to check out. They are essentially a minimum, but they are the key numbers that if you understand them, they will help to give you a solid foundation in order for you to really assess a particular investment into stocks or even funds before you make those investments in order to help you achieve your long-term goals. Okay, I'm going to walk across to the side of my room to draw on my whiteboard to kind of illustrate what these numbers are to you and break them down as simplistically as possible in order for you to grasp what they are and start to use them on your investing journey. All right, let's dive straight in and make that happen right away. Okay, so a quick reminder of what we're actually doing when we invest our money in shares, in companies, okay? So, first thing we're doing is that we are typically investing for some growth, okay? So we want our money to go into these companies, and over time we want that investment to go up in value. So we want some growth happening. The second key thing we're doing when we invest into shares is that we are looking for some income. And that income comes in the shape of dividend income, okay, which we can either take out as income to service our lifestyles, or we can reinvest that money to build up and compound for us over time. The third thing that we actually get from investing our money is that we get some rights and benefits. And this is one area that people don't often talk about a lot. The sort of rights and benefits that you could get from investing in shares include the right for you to show up at an AGM, an annual general meeting. And I remember very clearly during my days as a chief financial officer for a public listed company, one of the things that I had to do was show up every year to the AGM of that company. And there were various people who you'd never think existed, but their key purpose was to show up, to dress up, to come and have the teas and biscuits and show up for the AGM so that they could ask questions to the directors and the leadership of the particular company, okay? So in the same way, lots of companies that you and I invest our money into out there have a board of directors, essentially a leadership team, and those people get to show up at the annual general meeting, and we get to use that benefit, which can be pretty powerful, in order to ask them questions about the future of that business that we've invested in. Other sort of benefits that you can get from investing in shares include the fact that you might be able to get particular discounts, for example, and other perks that people get when they invest into particular companies that they have an interest in. Now, if your goal is making money and building wealth, which of course it is, which is why we talk about it a lot on this channel, the key focus really, as far as relating to these 7 key numbers I'm going to share with you today, will focus on these areas of capital growth and of us generating income from our investments. Okay, so let's begin by analyzing these key areas there. I'm going to start with the income, the dividends that we get. And there's a very interesting connection between the dividends here and the fact that your investments can grow over time. And the key thing to note is, first of all, is that dividends are decided by the board of directors. And then over periods, typically quarterly, those dividends are then approved and paid out to shareholders, okay? And you and I receive those dividends in pence per share. So for example, we might receive a dividend or 5 pence per share. But the key thing to note about dividends is that some companies pay them and some companies choose not to pay them, okay? And the reason for that is because it's directly correlated with the potential for growth in a company. So when you have a company, for example, utility companies that pay out lots of dividends, you will find that they tend not to grow as quickly as other companies that do not pay out dividends, or companies that choose to pay out little dividends and then reinvest the rest of their retained earnings into growing their businesses, okay? So that's a really important point to make. So you might be somebody who's interested in income only, or you might be somebody who prefers to give up some of those bits of income over time and instead get capital growth over time, especially if you're currently at the wealth accumulation phase on your journey towards achieving a particular goal. So companies that you might find that tend to have high growth rates tend to be tech companies, whereas companies that you might find that pay high dividends tend to be the likes of utility companies. Okay, so to look at these 7 numbers, we're going to start with the income side of this picture, okay? Okay, so the first question to ask, which leads us to our first ratio, is what is my dividend yield? So if I'm getting income every year, what's the return that income gives me essentially, okay? And that return is usually expressed as a percentage, okay? So I'm just gonna write that down. So dividend yield, okay, that's the first one, okay? And the dividend yield is calculated by comparing the dividend per share, which you and I are paid as investors, to the company's share price. And that comparison of that dividend per share to the closing share price of the company at the year end gives us a percentage. It could be 5%, 6%, 8%. It's a number essentially. And we want that number to be a high enough number, but we don't want that number to be too high, because if it's typically more than 8%, then it usually sends out red flags. So we want a number that is not 0, but a number that perhaps goes up to 8% per year, okay? So the key thing to do with this number is for you to be able to compare that yield to other forms of possible investment. So for example, what's the return you might be getting on bonds if you invested in bonds and received a coupon, okay? Or what's the return you're getting on property if you invested in a buy-to-let and getting yourself some rental income, comparing that to the dividend income that you might be getting from investing your money in shares. You might even take that percentage and compare that percentage to what returns you might be getting by investing and leaving your money perhaps in a savings account with your local bank, okay? So the key there is that we're using that to assess what that return actually looks like and then comparing it to other forms of returns that we might be able to generate by investing our money. This is actually a really important metric, this dividend yield, because a lot of investors who invest exclusively for dividend income tend to pay a lot of attention to this particular metric. In fact, it's one that we will be focusing a great deal more over time on this channel, as we in our personal lives are going to be exploring more investments for dividend income specifically over time. The other point worth mentioning relating to dividends is that it's worth noting that the majority of the returns that you and I experience in the stock market has actually come about because of dividends being reinvested. Okay, so when we think about the total return that you might generate from investing your money, it's actually been shown over time that the vast majority of that has come from reinvesting dividends rather than just from the stock market growing over time. So dividends play a critical role in helping us assess what sort of returns we are generating as investors. To see what the dividend yield number is for a specific company, all you need to do is go and find that number on your online investing platform. So for example, I use a platform called Hargreaves Lansdown as one of the platforms for our investing. And I'm just going to put up on the screen a picture for you to see where the dividend yield number is actually located for a specific investment. In this case, I'm using Unilever as my example, so you can see exactly where that dividend yield number is. I'm also going to show you what the dividend yield number looks like if you are somebody who's invested, say, on a platform like Vanguard. where they have various funds that pay dividends to us as investors. Again, I'll put it up on the screen so that you can see for this particular fund, the high yield dividend fund at Vanguard. I've put up on the screen a picture for you to see exactly where you might be able to identify what the dividend yield number is for a particular fund. Okay, so our second key number comes from answering the question, which is how safe are my dividends? Okay, and the number that gives us the answer to that is to look at the dividend cover. Okay, so the dividend cover is a ratio of the company's profits divided by the dividends that the company has paid in a particular year. Okay, that gives us a certain multiple, i.e. the number of times the profit covers the dividends that they are paying. So say for example, a company makes earnings or profits of 50 million pounds in a year, okay, and they pay out dividends of 5 million pounds in that particular year, okay. You'd see that 50 divided by 5 will give us a multiple of 10 times, okay. This demonstrates to us that the company's earnings adequately covers the dividends that they're paying out over time, and it gives us an indication for the sustainability of those dividends, i.e. the ability of that particular company to keep paying that dividend over time. You want to make sure that you are comparing that cover, that dividend cover, across a few years as well, so that you can see whether there has been consistency in maintaining that dividend cover over time. Okay, so now that we've looked at the income side of this particular picture, let's now move on to this capital element, the growth element of the picture. And the key ratios and key numbers we want to be looking at, the next one is for us to consider the earnings per share of the companies that we are investing in. This is known as your EPS. Okay, this is our ratio number 3. Okay, and the key thing to note here with the EPS is that the higher the earnings per share number, the better. Okay, because it shows that a company has made more profits for every single share that it has in issue. The calculation for that is simply the company's earnings, i.e. their profits, divided by the number of shares that they have in issue. Okay, tied to this very specific number of the EPS is our next number, which is the price earnings ratio, the PE ratio, okay, which is number 4. Now, these are related to each other because in the ratio of price to earnings, the denominator, the bottom number in the PE ratio, is actually your EPS number. So they are completely related. And the PE ratio is essentially telling us how many times the price of the particular stock is a multiple of 1 year of earnings. Okay, so it's a comparison of that price compared to the earnings per share. So it's share price divided by the earnings per share. Now, the key thing to note about a PE ratio is that the higher the PE ratio, the higher the number it gives you, the more expensive that particular stock is. So if you're somebody who's looking for a bargain, then you don't want to buy companies that have ridiculously high PE ratios. You want to look for companies that have fairly low PE ratios. But there is a really important sweet spot that connects the PE ratio to the yield we mentioned earlier. What you want to be looking for here is a low PE ratio, but a fairly high dividend yield. Because what that indicates is that you are essentially getting a high return on the dividends, but you're not paying a lot of money for that particular yield. You're doing it and buying into that investment at a low price earnings ratio. The PE ratio also has an alternative meaning in that it's an indicator of confidence in a particular stock, i.e. the higher the PE ratio, the higher perceived confidence in that stock, i.e. investors expect that that particular stock will be growing a lot faster in the very near future, which is why they might be willing to pay that multiple of price to earnings. So for example, if a PE ratio is 20, it's an indicator that investors are expecting a high growth for the future. Now, a high PE ratio is also an indicator, if it's ridiculously high, it's also an indicator that a company might be overvalued. Okay, so this is a particularly important metric that gives you a good idea for whether you are paying too much for a particular company or whether you are getting a particular bargain. Now, tied to the PE ratio is another ratio called the price earnings growth ratio, the PEG ratio, okay? Which I'm just going to mention now because it's one that people tend to look at when they look at the PE ratio. Essentially, what the PEG ratio is telling us is that it's taking a PE ratio, but instead it's looking at the earnings growth, because the earnings number is a historic number. It's an indicator of the profitability of a company in a particular year, okay? But with the PEG ratio, you are taking the price, the share price, and comparing it to the expected earnings, i.e. profitability of a company over time. Now, of course, nobody knows what the future is, but, you know, a lot of companies and the people on the inside, the board of directors, tend to have a good idea of where they expect their companies to be going. So I'm just mentioning that point in that it's a metric that people also look at when they look at the price earnings ratio, because they look at that really in order for them to assess whether it's still worth paying a particular price for a company, i.e. do they still think that a company is a bargain when they compare the PE ratio to where they expect the company's price earnings to be in the very near future, i.e. is it still considered to be a bargain given what they know about the expected future growth of that particular stock. Okay, so our fifth key ratio, it's a really important one, is the price to book ratio. Okay, so rather than looking at the price to earnings ratio, which is using earnings which is based on the profit and loss of a company, we're going to look instead at comparing the price to the book ratio. And the book ratio, the book is essentially the net assets of a company, which is based on the balance sheet of a company. So what we're doing with the price to book ratio is that we are essentially comparing the value of a company, call it the market capitalization of a company, to the net assets of a company. Okay, another way of looking at that is to say we're essentially comparing the share price of a company compared to the net assets per share of a company. But either way, we're comparing market value to the books, i.e. the net assets. In our personal world, we might call that our net worth. But in a company's perspective, we're looking at the net assets of a company. Now, what's interesting about that calculation when you think about it is that we want that number to be as low as possible, because what it indicates to us is that if that number is 1 or less, which is what we really want, it means that the market value of that particular stock is less than the book value, i.e. what we are holding and showing that asset to be on our balance sheet, on our books and records. Okay, so that indicates again to us that we are buying into a company that is worth exploring. We're buying something that has some value. So when you then compare a low price to book ratio combined with a low price to earnings ratio, you basically found yourself a potentially great investment. Okay, so you want to repeat a price to book ratio that's less than 1 and a PE ratio that's low. And it gets even better if that company is actually paying a dividend yield that is fairly decent, up to around 8% per year, okay? You've then found yourself essentially a company that is potentially an amazing investment to explore. Okay, so ratio number 6 is a bit of a complicated one, but bear with me because it will make a lot of sense at the moment, okay? It's to compare what's known as the enterprise value of a company. And the enterprise value is the sum essentially of the market value in shares and the debt value of a company. Because companies usually have an equity value and a debt value. When you bring them together, that gives you the enterprise value. So you're taking that number and comparing it to the EBITDA of a company, what's known as the earnings before interest, tax, depreciation and amortization, which again, this is a number that you can easily find in a company's books and records simply by going and looking at your investing platform, depending on what company, what platform you're using to invest. Okay, so that ratio is enterprise value divided by EBITDA. So this is number 6. Okay, so I'm mentioning that because it's an alternative calculation to this calculation here, which is a price earnings calculation. Instead of using the share price, we're essentially using the enterprise value of the company. So we're bringing in the debt element of a particular company. And you can find these numbers, again, by looking at a company's balance sheet, okay? When you add those two numbers together, you get what's called the enterprise value, okay? And you're comparing it to the earnings before interest, tax, depreciation, and amortization. Again, this is a listed number on a company's financial statement. You grab that number and you can plug it straight into that calculation and to get that particular ratio. Now, what this does is that it again gives you an alternative calculation to the PE, but it's giving you a somewhat much more superior calculation in that a lot of people tend to look at this measure as profit as one that is much more superior because it's stripping out the likes of interest, tax, depreciation, and amortization, okay, to give us a specific number. We want this ratio of enterprise value to the EBITDA number to be as low as possible, but we want to be able to compare that ratio to the sector average or to similar competitors for that particular company that we are looking to invest our money in. But like I said at the very beginning, this is probably the most almost seemingly complicated one of these ratios. But I can guarantee you that once you've gotten yourself accustomed to what these various terms mean, it will become almost second nature to you to look at these various ratios when you are considering making an investment into a company. Rather than just getting emotional about the investment, you want to dig in and really get comfortable with what these numbers are and what they are telling us about this specific investment that you might want to explore. Okay, so my final number is a really simplistic one, but one that many people have asked me about. And that number is your total return number, which is super easy in my mind, but for a lot of people, the total return is a bit of a mystery. Okay, so essentially, the total return that you are getting every year on your investment is the sum of two numbers. First, it's the return that's coming from the growth in your investment in a year. So imagine your investment goes up by 5% in a year, plus a second number, which is the dividend yield that you are getting from that particular investment. So let's say you manage to get a 3% dividend yield. Your total return in that example would be 5% plus 3%, which would be 8% for the year. Okay, so just write that down. Now on this total return point, I'm just going to put something up on the screen for you guys to check out what this looks like. For example, if you are investing in a particular fund, you will see that up on the screen that the total return for this particular fund, which I've explored, which is a high dividend yield fund on Vanguard, you see that particular total return, and the total return column on the right hand side is a sum of the capital growth on the left hand side per year, as well as the dividend yield that's generated by this particular fund in a year. In the same way, you would also look at your individual stock investments in that same way. You know, what has it done from a capital growth perspective in a year, and added to that what it generated from an income perspective when it comes to looking at the dividend yield. The sum of those two numbers together is what gives you that total return number for you to understand how your investment is performing. So there you have it, guys. Those are the 7 key numbers that you need to understand as an investor, okay? So like I said at the beginning, these are absolutely important. If you're somebody who has an interest in companies and want to understand how you assess them in order to make the right investments, to be able to buy the right companies, to buy ownerships in those companies without paying too much for those companies. These metrics are also important if you are somebody who is investing in funds, because ultimately those funds you're putting your money into are deep down in the chain invested into companies or into other funds that are also invested into companies. So do take the time to really understand these various numbers. Don't almost be afraid of them per se, because it might seem complicated. The key thing is to ask yourself, where are these various numbers? Where are they sitting? The dividend yield number you can easily get by just looking at your brokerage account, your online investing account. Just log in and search for a particular stock, for example, Unilever or your favorite stock, for example, just search for it and you'll be able to see what the dividend yield number is. So that number is already given to you. So you would know immediately what that number is now by having watched this particular video. Numbers such as the dividend cover is also provided for you by looking at your online investing account. I like to use Hargreaves Lansdown as a platform personally to be able to look up some of these numbers, and they are already calculated for specific companies that we might want to invest our money into. You should also be able to easily see such numbers as your earnings per share or your price earnings ratio. Those numbers are also already calculated for you. So all you need to do is to almost now start to assess them together. Rather than looking at these numbers individually, you want to start to look at them together. Like I made that point earlier, by looking at the P/E ratio of a company, you want that to be as low as possible and comparing it to the price to book ratio. And if that's low as well, then you know that you are potentially now making an investment that's worth your while. Key is to look at these all together, see them as connected together in various ways, and they are there to offer you specific clues to make sure that you are understanding the investment that you're making and making sure that your hard-earned money is going into companies that are truly worth your while. Guys, I really hope you've enjoyed that particular video on those 7 key numbers every investor needs to know. I'd love to know from you, what did you think about those 7 numbers? And which of them do you currently use or look at when you are thinking about making a specific investment every month or whenever it is you make an investment? Let us know in the comments. And do check out our previous videos. There's one I made earlier called How to Analyze a Particular Stock, where I go into a lot more detail actually beyond these 7 numbers to give you an idea on various other ratios that you might want to consider in order to continue having successful investments. Guys, thank you so much for watching this particular video. If you really enjoyed it, don't forget to hit that like button because it really helps to encourage a ton more people to engage with our videos. If you're new to our channel, come on, don't forget to subscribe, hit that subscribe button, as well as the notifications bell so you get notified when we publish our videos twice a week on a Tuesday as well as a Thursday. Thank you so much for watching this video, and I look forward to seeing you again on our next one. As ever, in all things, stay thankful and continue to seek joy. Take care and bye for now.